Nina, it's great to have you back. Good morning. I guess the question is going to be how some of those with cash are going to balance relative bargains, I guess, versus regulatory risk.
Well, thank you so much for having me. It's great to be back. And yes, it's certainly been a rough couple of weeks, and we're in what some people call correction territory for a lot of stocks, and tech stocks have certainly taken a hit. But I think investors are really trying to balance the macro of what's going on in monetary policy with the micro of company fundamentals as we kick off into earnings season. And despite the sticker shock of what is happening with inflation and interest rates in the public markets, I have to tell you, we haven't seen that same correction in the private markets. VCs are pouring tons of money into startups at record valuations, even over these last couple of weeks. So it's interesting to see the disconnect there.
Yeah. What leads you to cloud if we're looking for new baskets where M&A might heat up?
Well, I think you have to take a step back, right? The last 2 years, people really weren't only buying tech stocks because interest rates were low. People were buying tech stocks because they believe these companies are disrupting massive markets, and also because SaaS is, quite frankly, one of the best business models you could invest in, even if you're starting to think more about profitability versus growth. For example, SaaS has high margins, very low churn, great net dollar retention, and predictable revenue. And so if you think about a lot of these stocks that have gotten punished, Zoom, Asana, DocuSign. Zoom went from $100 billion market cap to 48 today. Asana is less than 12. DocuSign, 25, $26 billion market cap. These are all companies and products that are still delivering to their end customers. So I think you have to take a step back and ask yourself, are these companies still worth investing in with this dip? And honestly, with this discount, it's almost like buying a Ferrari, same engine, same horsepower at a 50% off discount.
Right, Nina, the public market seems to be valuing them in a much different way than the private markets at the moment. The names you mentioned have all gone public over the last few years. What do you tell your portfolio companies about going public when they're getting oftentimes better valuations, better terms in the private markets? Is it making it less appealing to go public? How do you think about your exits?
Well, I think the private valuations are very different, right? They're driven by simply a function of supply and demand. And as we saw last year, VCs in the US raised $128 billion just in the US, right? And so a lot of these VCs, when they raise this money, they have to deploy this capital in a certain time period, 2 to 3 years, which means we can't sit on the sidelines and wait for the public companies to come back, public markets to come back. And so if you meet a great entrepreneur who's building a multi-generational tech company, you really want to encourage them to think about long-term, not to think too much about what's going on in the public markets. And that's why a lot of the prices have gone up. When you meet an entrepreneur that's building these companies like the Confluence or Datadogs or Snowflakes of the world that are all trading above their IPO, it's really hard to pass up that opportunity. That said, I think we have seen a couple of companies decide, let's wait and see how the first rate hike is digested by the market. But I believe that the companies that are going to go out in 2022 with strong fundamentals, I think they still will.